So, hold on, let me just... So yes, how unemployment indicators drive financial markets. So we'll look at... So the reason I've just done that is because I didn't click record on the webinar. So that's annoying. Anyway, right, okay. To start off with, why unemployment is a crucial factor in financial markets. Right, okay. First thing to remember is it is a main driver of central bank monetary policy, and unemployment is a key feature of, say, for example, well, certainly the Fed has its dual mandate, and unemployment is a key feature of that, and subsequently the Fed looks at unemployment. Pure and simple, the Fed has a big look at unemployment when it sets monetary policy. Subsequently, it has a key sort of driving force in the markets. At a basic level, if the economy is strong, then jobs are going to be created and the level of unemployment will be falling. If you take it as a cycle, then the creation of jobs are going to mean that people are going to have more money to spend, and that's going to help to improve economic activity. So, sort of strengthening job creation will lead to economic growth. And depending upon, this is again a key feature, as I focused on last time, depending on the base of monetary policy that's already being engaged, economic growth can potentially also lead to inflation that needs to be dealt with through monetary policy. But even at a sort of very low level, the market still reacts to unemployment through the whole expectation of how it drives monetary policy. So that's why, sort of, aside from the political benefit of the sitting government, and reducing unemployment will often be a direct and potentially an indirect aim for the central bank, but certainly in the case of the Federal Reserve, it is a direct aim because it's put down in statute as part of the dual mandate. So if unemployment is rising, then that's going to be an indication that the central bank is looking towards future economic growth could potentially contract. And the reason is, as you can see here down in your little cartoon here, that if someone loses their job, sooner or later their spending patterns are going to change. They're going to start knocking off different aspects of their spending as they realise that they haven't got the money to continue their lifestyle as they had it before. And if that's seen as in an aggregate across the economy, it's going to have a big impact, certainly across economic growth. So what the central bank will look to do is try to tackle rising unemployment as it starts to happen, and looks to adjust monetary policy in order to sort of help the economic conditions to be more favourable for job creation. And the main way this is done is by reducing interest rates. So when you reduce interest rates, it becomes cheaper for companies to borrow, and it also obviously reduces the amount of interest payments that individuals have on their personal debt, and subsequently life becomes cheaper, and subsequently through that you sort of start spending money and just generate the economy that way. So that's why they would act on rising unemployment by cutting interest rates. So therefore the market will sit up and take notice of unemployment data as an impact on monetary policy. So central banks are basically looking for an ideal level of unemployment, really, where inflation is stable. Now, just a quick look at economics, very quickly. Basically, unemployment and inflation are pretty much a sort of a trade-off between. There's a trade-off between the two. That's the word I was looking for. And in economics, there's such a concept as the non-accelerating inflation rate of unemployment, basically whereby you can cut unemployment to a level at which inflation sort of gets to a point at which it starts to go up quite strongly because the unemployment level is so low. And the reason is because everyone, well, I say everyone, because the market, the economy has got so much job creation in it, that the supply of labour goes down, therefore any employers looking for labour force, the sort of bargaining tool, the bargaining chips sort of lie firmly with the labour force in terms of being able to sort of argue for higher wage growth, and then wage growth subsequently feeds through into the economy, and sort of that's how it starts to generate inflation. And the Fed is a key, or certainly is on record as looking at the NAIRU level as a point at which the inflation will start to filter through. Now, as you can see in the chart here on the right-hand side, the Fed's expectations of NAIRU have actually dropped, or continue to drop at the moment. And previously they were around about 5%, and I think last meeting, or a couple of meetings ago, they even dropped it below 5% as unemployment continues to fall and inflation remains absent. So the point at which inflation starts to come through is the point at which the Fed sees that as sort of almost the level of full employment, I suppose, is the argument. And their expectations of full employment are sort of between I think it's 4.6 to 4.9 at the moment. So that's the level at which they start to think inflation will certainly start coming through the system. Right. Wow. Economics. So why does unemployment matter? Well, as I said, central banks are very interested in the level of unemployment, and looking at the dual mandate, for example, on the Fed, it sort of means that they need to balance how they manage monetary policy. And certainly, I mean, for example, if you look at the 1970s when they had stagflation, where inflation was extremely high, but unemployment was also extremely high as well. It must have been very difficult for them to actually engage monetary policy, or to set the correct monetary policy, because they didn't really know what the impact would be on either of the two levels, because obviously both were extremely high. So it becomes a very difficult place to be in that situation. But obviously at the moment we're now getting back to a level of about 5%, and that's where, as I said, the Fed looks to be close to be have a level of full employment. So as a general rule, what you're looking at is lower unemployment will lead to higher consumer spending, as I said previously. You also get increase in tax receipts as well, so the government's spending can go down, so the fiscal position of the government looks a lot better, because they don't have to keep spending out on social security and therefore also they're getting in income tax payments through people having more jobs, and subsequently the whole economy starts to improve. So low unemployment is better for the economy, and it's a virtuous circle, you'd say. So that does then therefore have impacts across different asset classes. Now, what it does therefore do is drives up expectations. Expectations of an improving economy will drive up expectations of tighter monetary policy. And that is the key to the whole situation. Now, okay, unemployment as a laggard indicator. This is always sort of thrown at unemployment as an indicator, because it is seen as sort of almost late cycle, isn't it? I mean, if you just sort of take a step back and look at all the big banks making swathes of redundancies, that generally happens when the proverbial has already hit the fan, and the economy's already deteriorating, or the economic outlook is already deteriorating. So hence unemployment is seen as a laggard indicator. Is that correct? Well, I suppose, I mean, I've got a few charts here on this slide that you might want to look at. I'd say it's inconclusive, really, because you're sort of looking at the fact that this is the US economy, unemployment here on the top, non-farm payrolls data, S&P 500 and dollar index. You can certainly start to see that unemployment bottomed in 2007, pretty much around the same time that the S&P 500 topped out, and then unemployment starts to go up, and the S&P 500 starts to go strongly down. Interesting that I think you can also say that the dollar doesn't really perform in maybe the way you'd think it would, with falling unemployment in the States, possibly because it's seen as a safe haven trade, or certainly was during the 2000s. That may be to do with it. I'm not an economist and I haven't done any serious analysis of that, but it could be the fact that it was seen as a safe haven trade. But certainly I think stock markets turned with the bottom of unemployment. And also look at payrolls as well, starting to go negative. When payrolls started to go negative for a couple of months, that's pretty much when the market started to top out. Also, you could argue the US dollar starts to perform better in Q3 2008. I've noticed here started to perform better, and that's pretty much as the unemployment data, the non-farm payrolls data started to sort of hit its bottom. Dollar peaked and the S&P troughed in 2009. Where was that? S&P 500 troughed and dollar peak in 2009. Again, in line with the bottom of payrolls. And not far off the top in unemployment as well. Again, I mean, I'm going to look at equities and unemployment in a bit, but you would argue if you're a longer-term equity investor, you want to be investing. You want to be putting money into the market when the indicators are at their worst, don't you? Because that generally tends to be the bottom. So you look at non-farm payrolls. Certainly was around the bottom of the S&P 500 when non-farm payrolls bottomed. Unemployment as well started to maybe a little bit laggard in the unemployment data. And what was the top of that? That was Q4 2009, and that maybe it's more of a confirmation indicator on a longer term basis anyway. But certainly I'd be looking at payrolls as a trend as well. I think it can have a part to play in the longer term analysis, but also I think. Which is what we'll talk about in a second, which is non-farm payrolls. You want to use it as your very short-term indicator, but it doesn't. I think it's more of a confirmation indicator is basically what I'm getting at, rather than sort of a serious laggard. So the impact of non-farm payrolls. Well, obviously traders want to know how the biggest economy in the world is progressing, which is why once a month, on the first Friday of the month, and I say first Friday, I think, and I might be wrong in this, but I think it has to be the first Friday of the month when there's also a Wednesday there's the first Wednesday. So basically you get the ADP employment data out on the Wednesday prior to that. So you can't basically have non-farm payrolls, I think, on the first of the month is basically what I'm getting at. So we get non-farm payrolls out once a month, and the market really does have a look at non-farm payrolls. It really does look at how the payrolls report has come out and the implications it has for the US economy, because as I said, it's seen as a driver of future growth. Certainly considering 70% of the US economy is consumption based, therefore you want to see the US creating jobs, money going in people's back pockets so they can then spend it. It's not a massive rocket science to understand that. So on a monthly basis, it is pretty much the single most important economic data release. And I say economic data release because you sort of obviously got the focus on the Fed and the ECB and things like that. But I think in terms of pure sort of data point, you'd say that non-farm payrolls is the big one that everyone looks towards. It is it doesn't include the volatile farming sector, so therefore it's called non-farm payrolls. And non-farm payrolls comes as part of the employment situation report, and it is that whole report, because of the different aspects of the report, it has a tendency to create significant volatility because different people look at different aspects of the report and take something else from it. So there are key factors to look at there. So let me just see. So yeah, it's gonna have an impact across financial markets. Positive surprises would generally tend to be the fact that the US economy is strengthening and increasing expectations of a future rate hike. Again, it's fairly sort of standard stuff that we've been talking about in the last few weeks, and it certainly has a big impact across across different asset classes. So what do you want to look out for? Well, obviously the headline payrolls report number is the big factor that everyone looks at. But is that the only thing in the report? No, it isn't. We've got the other three important features here, which are average hourly earnings, unemployment, and participation rate. Now, unemployment is obviously the percentage of the population that are actively seeking work but are unable to find employment. And it's a classic sign for, as I said, for economists and also the Fed. The Fed wants to see unemployment falling, or certainly moving close towards what it considers to be full employment, because that's what is put down in statute in law. So that is a stated aim of the Federal Reserve. So the unemployment rate is very important. Average hourly earnings is increasing, or certainly recently, seems to be recently, that average hourly earnings has been important because it is seen to be a measure of future inflation. As I said earlier, when you start to see employee wage growth picking up, again, simple stuff really. If employees have got more money in their back pocket, they'll be looking to spend it, and that's going to be pushing inflation in the future. So it has generally has a feed through into inflation now. So not only that, you've got the participation rate as well. Participation rate is the percentage. Let me just look at this. The proportion of people in the labour force that are either in work or actively seeking work. It's important because it's in the context of analysing unemployment, as sort of you might well find that certainly in recent years, or in the wake of the financial crisis in 2008-2009, a lot of people have dropped out of the labour force and been discouraged from looking for work. So that is driven the participation rate lower in the States. And it's a big concern of the Fed, the fact that the participation rate continues to fall, and it can have an impact on unemployment as well. So that's an important feature. So the Fed's going to basically look at all these things and come up with the overall outlook for this for the labour market as a whole in devising monetary policy. So your sort of more experienced traders are going to look up different aspects of the report and don't generally tend to be too blinded by the payrolls headline, which obviously gets the big headline news. So how does unemployment impact on forex markets? Well, as I said earlier, it sort of has a big feature on, or a big factor on domestic currency. So obviously, we've been focusing on the US with non-farm payrolls. So starting off with euro dollar, this was the chart of euro dollar on the last payrolls report, which was on the 8th of Jan. And what we had was an interesting payrolls report, because payrolls basically came out pretty strong, very strong headline. I think it was 272. Might be wrong there. I think it was 272. And that was considered to be a very strong headline, hence why the market sold off significantly. But what subsequently happened was we had disappointing wage growth as part of the report as well. And the market, as I said, is looking for wage growth to come through the system as to give an indication that inflation is ready to come through. The wage growth disappointed in the event, and subsequently I think markets looked at that, obviously looked at the headline as the initial reaction, whereby 108.60 down to 108.05, so 50-60 ticks to the downside on the headline number, and then you saw a complete reversal of that, I think because of the wage growth, the lack of wage growth coming through the system, which sort of reduces the sort of means that it was a mixed report rather than sort of an unambiguously strong report, and meant the FOMC could not hike necessarily so strongly. As a general rule, though, and I say this in the, looking at this grey box here, as a general rule, you're sort of looking to buy the dollar on strong payrolls and selling the dollar on weak payrolls. And as I said, be careful of the report as a whole. And the key impact is the expectations, market expectations. Looking at bonds now, similar sort of reaction really. We had as a general rule, let's just start off with the theory. As a general rule, strong employment data is going to increase the expectation of tighter monetary policy. Hence why you'd get selling pressure through bonds. So that would be bond yields going higher. As I said, stronger labour market reduces the need for looser monetary policy and could be inflationary. So therefore, you need stronger monetary policy, and that would be interest rates potentially going up. Interest rates going up are negative for fixed income assets, such as corporate bonds and government debt. Subsequently, you see the yields pushing higher. Now, again, a similar factor on this report. You saw the strong reaction initially, where this is the 2-year yield on the US Treasury, went from 96 up towards 101. So that was a significant reaction, but then subsequently sold off sharply again, as I think because the market was a little bit spooked by the earnings growth or lack of earnings growth through the system. Equities. Now this is an interesting one again, because improving employment data, as I said, leads to is an indicator of a strong economy, and a stronger economy is a stronger environment for consumers and corporates. Therefore, corporates are going to be making more money. Therefore, earnings are going to go up. Therefore, improved earnings in corporates means that equities start to look cheaper, and therefore prices go up. Looking at it the other way, though, if you look at rising unemployment, or I suppose worsening employment conditions, it's going to be a negative on corporates, isn't it? Because unemployed people have less disposable income. Additionally, you look at things like housing market. With the less disposable income, that's going to impact on your consumer discretionary stocks, sectors such as the housing sector will be impacted because it increases the potential for foreclosures, people not being able to pay their mortgage, so they have their house repossessed, and then also you get banks stuck with a load of bad debt as well. So not only will housing related stocks get hit, but also you would get an impact on the banks as well. So anything sort of consumer, sort of housing, sort of banks related is going to be volatile around the employment data. So that's within the equity markets, but as a whole, you generally tend to see that a strong payrolls report would be strong for markets across the board, equity markets across the board, because obviously so many equity markets or companies are linked to the US economy, and the US drives the world economy effectively, well, the US and China, but certainly the impact of the US is felt across the world. In this case, we can see last month FTSE 100 rallied fairly sharply, not a huge amount. What was that, 30 ticks higher in the sort of first few minutes, and then started to fall away again. Again, it seems as though that the market sort of reversed sentiment, didn't it, on that instantly. So all these markets are turning around at the same time, aren't they? It's like 3-4 minutes of a move, and then it started to turn around. So they're all sort of moving in the same way. So if you're running positions, say for example you've got an index trade on and you're running Eurodollar as well, they're all going to be interlinked. They're all going to react off this payrolls data. So that is something else that you need to sort of make yourself aware of. And finally, gold. The impact of gold Gold is generally tend to be seen as a safe haven, really. So strong payrolls report is going to be negative for gold. And gold, I have to say, does react significantly on the back of the payrolls report. Now, this one was an interesting one because it didn't really last in terms of the trend. But I've seen the gold price start to move quite significantly on the back of the payrolls report. So you're looking at sort of often like 20 or 30 ticks to the downside is quite often seen. So we need to be aware that gold is a mover on the payrolls report. So in this instance, we've got the gold price which sold off quite strongly. So we went from $10.99. Well, I say strongly, it was $5 actually, but it did react and then started to turn around again. So after about 5-6 minutes, again started to turn around, didn't it? So all these markets turning around at the same time. So you need to be looking at across asset classes when you're looking at this payrolls report. They all move. They all are reactive to it. And again, this is generally seen to be a driver through the earnings growth. Or lack of earnings growth, because lack of earnings growth hit the dollar and sort of pushes out the expectations of future rate hikes. Let's just say that through the Fed, and subsequently the dollar got hit, and the dollar and the gold price generally tend to be quite negatively correlated. So hence why gold started to rally as the dollar started to sell off. So I can just quickly show you that through euro dollar. You got that gold rally after a couple of minutes. This is the dollar strengthening, and then the dollar started to weaken again. And basically that chart is the same as that gold chart, isn't it? So let's just show that gold chart again. Isn't it? Like you had that initial sell-off and then the gains. Same as the Eurodollar chart. Very similar charts in the reaction to payrolls. So you need to make sure that if you are exposed to more than one asset class like gold and Eurodollar, you need to be set up in a way at which you're not overexposed. You're not over sort of leveraged on your positions, shall we say. So that is the sort of end of the presentation in that regard. But let's have a good look at these markets now, because these markets have had some strong moves. Now let's start with Eurodollar. Again, anyone who wants me to look at something that they're trading, I will have a look at it. But in the meantime, I'm going to just go through the Forex majors and then look at gold, DAX as well. So let's just quickly run through. Got a bit of time, so I can talk quite freely. So hold on a sec, I'm just going to have a drink. Right, Eurodollar. Fat, isn't it? I think Eurodollar is looking for direction. I don't think it's got direction at the moment. We had this sort of declining outlook, which was a bit of a sort of a negative trend channel. It was very shallow, and it wasn't sort of driving the price lower. And what we've seen subsequently is the sort of few intraday moves through the downtrend line, but you would still argue that that downtrend line has a part to play, and that's the reason I'm still sort of mentioning it on my daily report. I don't necessarily think it's a key move, key driver for the for the euro price at the moment, but still, I think it's something that we need to look at. The reason being that I think that the euro is far more concerned with sort of the resistance around 109.50. Seems 109.45, 109.50 tends to have been a bit of a ceiling, hasn't it? That was an interesting move a few days ago, where we had several candles moving through it. And that to me looked like I sort of took that as the fact that the market may be starting to sort of get a bit more confident that the euro is going to push higher. It sort of didn't really come through though, and look at these momentum indicators. RSI 51 MACD lines absolutely dead flat. Stochastics slightly higher. On the balance of it, you'd say, oh gosh, slightly positive, but again, nothing really. I think the euro is looking for direction at the moment. It's very interesting actually, because the euros tends recently to have been seen as a safe haven play, in tune with the yen. The yen is still, I think, the classic safe haven trade. Let me just show you the yen. But is it now turning around, the yen? You've been in this downtrend for the yen in the last sort of 3-4 weeks. We've now got a bit of a bottom in place, I think. And could it be that that might have an impact on the euro? It is possible. Sorry, my chart's not responding. I want to go back to the euro. Come on. Come on. There we go. So is it possible that if that is the case and the dollar yen does start to bottom, and that would suggest presumably dollar strength and improving market outlook as well, generally, because the yen is the classic safe haven trade, the dollar yen, for currencies anyway, and that could well put the pressure to the downside on the euro again, because the euro, as I said, has been sort of treated as a safe haven trade at the moment. Now it's interesting because this old floor, how many times have I mentioned this? 108.10. This old floor, big floor, through the sort of the middle of summer, became resistance and then supportive again. That broke a couple of days to the downside, but again, look how many times in the last few days this has become the basis of support. If you look on the hourly chart, it actually goes down to 108 figure. 108 figure is the sort of level that we need to look out for. How many times has that been supportive? And also a basis of resistance as well, minorly, but supportive again. So 108 figure is your sort of big near-term pivot, I think, on the euro. And if you break below that, then I think you're going to go lower. Certainly would be a test of that 107.10 level, which was that reaction low on the 5th. But at the moment, I think we're just trading sideways within this sort of band, aren't we? Almost sort of two big figures are sort of 108 to 110, and then obviously if you're looking at 110, then you're looking at 110.50, which is this long-term pivot band. 110.50 to 111. How many times has that acted over the past sort of year as sort of turning level on the euro? Very interesting. Was that 10.46? No, 10.48. Look at that! Wow. In December and then off. So it is a massive level. I still talk about that a lot, possibly too much, who knows, but anyway, but yeah, I still think that is a big level on the euro. So I think generally speaking the euro is slightly sideways, and I think it's going to be driven by risk appetite generally, so we're not really getting too much direction. Cable, wow, what a turnaround today. We had strong inflation data for the UK, actually reacted higher. It was like 70-80 ticks higher, pips higher, and then as the US has come in, it's absolutely smashed it. Absolutely smashed it. It was got to 43.40 today. It's sort of almost 200 ticks to the downside on the back of that. It is 200 ticks actually, 41.27. 200 tick turnaround. Wow, that is a big sell-off. Cable just keeps getting smashed by the States, isn't it? Every time. Look at that big bearish outside day. It's just incredible. 15 on the RSI. When was the last time we got to 15? 12, 13 on the September 2014. September 2014 was just before the Scottish referendum vote, interestingly enough. But look at that sell-off. Just not stopping, is it? I mean, and that is a long trend as well, isn't it? When you look at the sort of trends that tend to sort of stop and have a consolidation. That is a long trend on cable. The argument, therefore, would be: is it going to turn around? Well, I mean, it's not turned around on the inflation data, and the US has come in and smashed it. Partly, I think, because we've seen a bit of a turnaround in the oil price today. Turnaround down lower, so that's not great for risk appetite, and obviously sterling at the moment is certainly not a safe haven play. So we're getting sterling smashed again. I mean, surely, and I hate using this word because it's a really lazy word, but surely we're close to a bottom on cable. But again, today's move is not positive at all. Yeah. Now, I keep saying it in the daily chart analysis, but how often are the old supports being new resistance on cable? You're getting so many times we're seeing it coming through, whereby you got the 140, 145, got the old support failing in the rally. 143.50 again, old support failing in the rally. So old support becomes new resistance. So you start looking at the latest support, which is 42.30 area. Now 42.30 is the massive May 2010 low. 42.30. So now we've sort of smashed through that. I'm looking at 40 figure as a general, and as a sort of a psychological level, and maybe even 135 figure, which is basically these lows. 135 figure from Q1 2009. Really big downside move. Right, sorry, I've just got a question here from, I'm going to really bad with my pronunciations, Xiang Chu, hopefully. Do you think the ECB meeting this Thursday will impact negatively on euro and deter investments from picking euro as a safe haven, which strengthen the euro? Now, my thoughts on the euro this Thursday. I don't think they're not going to do anything with the rates. They've just cut the deposit rate, so they need to see how that reacts. They've cut it by 10 basis points. It's not a huge cut, but still they've cut it. They got a load of flack for only doing 10 basis points, but that's again in the past now. I think what Draghi will do is he'll desperately try to jawbone it lower. He'll desperately sort of talk about the potential for further easing measures. Euro lower, because let's go back on it. Back to the euro. That was the ECB meeting. Last meeting. This huge candle down from a low of 105.40, and added sort of 450 ticks in the day. Incredible move because of the disappointment. Now, if Draghi can jawbone it low, which he may well try and do, on a technical basis, I think 108.10 is that key level. And it'll be interesting that I think he is, maybe his stock has diminished somewhat from being quite decisive and in his assertion that the euro would be pretty much there'd be sort of drastic easing measures, and the market didn't get it, and that would suggest that Draghi's, in my opinion, I think that would suggest that Draghi is not as strong on the committee, and I think the Germans are still battling to prevent further easing measures. I think he will talk it lower, but I don't think it's going to go too much lower. I think the euro is. I think we've seen the low for the euro. Put it that way. I think that 105.38 is possibly a low, but also that 104.56. I don't think we're going back to parity. Although I think I still see the euros choppy in this sideways range in the past. In the coming weeks and months. I don't think it's going to go any lower than that, and I think any dips will ultimately be bought into because it does still act as that safe haven play, and markets are still fairly tetchy, and I think that sort of keeps the demand for the euro in place. So I don't think it's going to be going too much lower. Breaking new low on 1.456 in 2016. I don't think so personally. I don't think we're going to see parity. I think if we were going to get parity on the euro, we would have got it through the big sell-off on the big dollar bull run that we saw, and I think the dollar has now ended its bull run. I think the fact is, obviously, you've got two sides to the trade. You've got the euro and you've got the dollar, and I think the ECB is going to struggle to meet any expectations of further easing, and that's going to help underpin the euro. And I think the Fed is going to struggle to tighten too quickly. I think they're going to get 2 rate hikes at most this year, and I think that's going to subsequently mean that you're going to get choppy sideways moves on the euro dollar and not too much else.
Okay, from Salman, a question, if you don't mind: is there a way of how to identify, predict trend in early days? Wow. Last question. What's the name of the software chart you're using? This is my Reuters Cobra. Reuters Cobra, that's a complete lie. Reuters Icon. Reuters Icon is my charting package. It's the I think it's the top charting package that Reuters do. Anyway, back to Salman. Question, if you don't mind: is there a way of identifying how to predict a trend in the early days? You've got, you've got. I think you sort of look at the balance of indicators, really. How can I illustrate this? Okay. What is trending at the moment? Obviously, cable is trending at the moment. Back on cable. So you'd look at how this trend in cable is starting to turn around, and I think you would. I mean, it has. The trouble is with cable, it's accelerated, so it's accelerated away from this downtrend. I mean, because obviously you'd look for a broken trend. You'd then start to look for the positioning of a higher low, whereby you've had a reaction. Anything can bounce, but then what you're looking for is a new support, a higher support in place. And then once you've got that higher support in place, you want to start to see a higher low. So you're looking for the posting of higher lows and higher highs when you're sort of looking for a downtrend turning back, turning round into an uptrend. So that's generally the start of your trend, is when you see a bit of a zigzag higher. So you've sort of hit let's go all the way back. Here we go. That's not too bad. That's not too bad here. So you've seen this run higher in cable, and it looks like it's sort of not as, the trend is not as strong. You're sort of seeing the trend shallowing out, and then you start to see this lower high coming in, and then you start to break the previous reaction low. And that is that point at which you start to think, well, this is definitely going sideways, potentially even building a new downtrend. And then you start to see a lower high formed and a lower low formed. So you start to see the turnaround. You start to see, instead of seeing higher lows and higher highs, you start to see a lower high coming in below there, a lower high and a lower low, and then another lower high and another lower low. So you start to see this sort of trend turn around, and you're looking for then confirmation across your momentum indicators. The ones I use are pretty good, I think, for trend formation as well. Certainly the RSI, I think, turnaround stories. And the MACD lines are pretty good for trend formation. You want to use MACD lines, I think, in trending analysis. So that's why I think it's pretty good. But yeah, I think you're looking for the formation of a turnaround in the market. Okay, so dollar yen, is this a bottom? It's very interesting that 1646 is coming in. 1668 was the low on the 11th, last Monday. 1648, 1655. I mean, it's just holding on to these lows, and now you're breaking that downtrend. I've drawn in here a downtrend on the RSI, so you're starting to see this downtrend broken or breaking. If it continues higher, you'd start to now look at, as I said, the lower, the latest reaction high being broken. The latest reaction high being 1837. You're also looking out for this Fibonacci level to be taken out, which is 23.6 on the hourly chart. Dollar yen. 1875 is a big pivot level through through the early days of 2016, isn't it? How many times pretty much to the pip as well. 1875 got hit as support and then got broken and became resistance. So that is a big level on the upside. If that breaks through to the upside, I think you're starting to see a turnaround. But here we go. Here we go on the hourly chart. You can see here just consistent lower highs, lower lows. Now, if you start to see, as I said, 1835 taken out, that is 1835, 37, but let's say 35. If you start to see that taken out to the upside, then it starts to turn the outlook around, and I'd say that would be confirmed through the RSI, the hourly RSI pushing above 70, because that would suggest more stronger momentum. Consistently, the RSI has been moving towards 30 or below 30. I think the fact is that it's now hit 70. That's a positive, and if it starts to go above that, I think that would be increasingly positive. So I just think, generally speaking, this is beginning to turn around a bit. And I think it could well be that we start to see a bit of a recovery. It is interesting that it is happening. It's not responding again. That's annoying. It is interesting that it's happening at the moment, because it still seems as though the markets are not entirely sure. I mean, as I said, cable completely turned around today. Let me look at the oil price, because that could tell us more. Oil price, as the US has come in, has been smashed. Smashed. It was beginning to turn around, wasn't it? $30. Old support, new resistance. Again, you'd argue new resistance, 30.21. Hit that, came off. Overhead supply around here. The market just does not want to push on, does it? RSI on the hourly chart. What is that doing? RSI on the hourly chart. Every time it gets towards 60, it sells off. MACD lines, every time it gets towards neutral, sells off. It just doesn't want to go, doesn't want to recover, does it? Again, sequence of lower highs, consistent, until you get a break above 30. I would say 32 again, because that's another lower, that's another old support and new resistance. I think until you get above 32, I wouldn't trust this as a rally or a recovery play. It doesn't look great, does it? Okay, let's look at the DAX, because the DAX was strongly higher earlier. Still higher, but yeah, I mean, again, you've unwound, which is a positive, I suppose. You've unwound and held on to the gap, so that intraday gap has been filled and pushed higher again. But I'm saying, I would say that's still not amazing. .GDAXI, not convincing for me. Again, sequence of lower highs, lower lows, old support becomes new resistance. Not massively, but I mean, still you'd argue that it's a resistance in place there, or an overhead supply. All the traders who are buying in this, who've seen the market fall through here, would now be thinking, well, anything back towards entry is a decent time to come out again. So that would be why the overhead supply is coming in. And you got the resistance now between sort of 98.10 to 98.85. So you've got that overhead resistance in place. Again, look at the RSI, hourly RSI, unwound to 60, rolling over. MACD lines unwound to neutral. Look like they're rolling over. Stochastics are already rolling over. Look at the last time we had a stochastic sell signal. Big sell-off. It's not great. Not great. Still, we're looking out for. Still we're looking out for, I think, selling into rallies. I mean, I did FTSE this morning. Yeah. Yep. Old support becomes new resistance again. Where am I? Where's my crosshair? Give me a crosshair. Old support becomes new resistance. Old support here, 60.30. New resistance around that 6,000 area. Old support. I mean, again, the overhead supply in this area selling off. It's similar. I mean, this does look very similar to DAX, doesn't it? Where you had this minor rally into it, couldn't hold off the sellers, and then again we've rallied back to that resistance, and it looks like it's unwound on the hourly RSI again. Look like you're going to get a stochastic sell signal again. Hourly RSI up towards 60 again. MACD lines again back to neutral, selling up. I mean, it's just the same features on these charts time and time again that we need to account for. Let's look at Kiwi. I thought was interesting because Kiwi has had a good day, and it seems to be holding on to its good day. So NZD equals. Now, it's sort of breaking this downtrend, isn't it? Breaking this downtrend. Is it breaking this downtrend because it's going to start engaging a rally? Well, it's not had a strong candle for ever since that sell-off began at the beginning of Jan. And you'd hardly call that a strong candle. That's a very neutral candle. So today is a pretty strong candle. It's turning around. It's breaking that downtrend. You're seeing the RSI back at 30. It's now above 30. Stochastics turning around. Is that a crossover? I'd certainly wait until the stochastics rallied above or moved above 20 before that is a confirmed, arguably confirmed buy signal. MACD lines starting to bottom, are they? I think it could be. It could be a recovery. Early stages. Again, this. I mean, Salman was going on about what the early stages of a trend. Well, you're seeing now this downtrend broken. So when a downtrend breaks, you start to think, well, okay, your immediate reaction is it's going sideways. Interesting here, 65 figure. I've got the line in here. Old support area, new resistance area. Time and time again, it sort of failed at 65. It needs to get above 65, doesn't it? And hold above 65. So 65 big figure is your level. Look at the momentum indicators though. Much better on the RSI, pushing towards 70. Holding on to the that 40 level in the last 2 days, isn't it? That's a positive. So instead of buzzing between 40 and 60, which is a very neutral outlook, which is what we had, it's now broken through that 60 level, pushed towards 70, and that's not really been seen for a long while on that. Yeah, ever since the sell-off began at the end of December, we've not seen the RSI consistently around this level in the sort of 70s area. So if that again, that is a signal of a possible turnaround. So 65 figure, I can sense tomorrow this is going to be my chart of the day. I like this one. Can sense around 65 figure, that is a big level that you need to see the Kiwi breaking through. Yeah, that's the level that which certainly would be a change of outlook. Okay, one more because we've got a couple of minutes. Gold. Oh, why have I chosen gold? So, turn into a dull chart, isn't it? Downtrend. You're back and using that 1077 level again. Old support 1077. Time again, 1077 on an intraday basis. The market failed on a daily basis. Again, failed on a daily basis on the sell-off. So that becomes your basis, or certainly pivot level. And you're in this downtrend phase, so you're not anywhere near now in your rally phase anymore. I think you're neutral on gold. Momentum indicators would certainly suggest that. Not really showing too much, although you'd argue if those stochastics start to rally again, maybe if you could break through the downtrend, that would start to see it more encouraging outlook. 1098 is the level I'm sort of turning more positive on. Again, failed just under that the other day, which was Friday. And again, it sort of failed 1099. So 1098, the old support here, which became new resistance, again, I think is back in place. So 1077 to 1098, I'm neutral. Above 1098, I'm positive. Below 1077, I am a negative. There or thereabouts. Anyway, so, well, great. So thank you very much for listening today. Back on the disclaimer just for now. And I wish you good luck in your trading. Those markets are quite difficult at the moment. Lots going on, lots of volatility. You've got ECB this week as Xiang, I hope I pronounced that right, has
pointed out. And yeah, so good luck in all your trading, and I will speak to you next time. Thank you.